Now, share prices of Safaricom and top banks, including Equity and KCB, have witnessed a sustained drop, pulling the combined wealth of Nairobi Securities Exchange investors to levels last seen 10 years ago. The bourse has also witnessed heavy foreign investor flight. For more, we were joined by Nderi, a financial analyst from ABC Capital.
As you've seen what has happened globally, I think we must have had a swoosh because all the funding more or less dried up. There was a lot of money moving back to foreign markets. In our markets here locally, we've seen quite a sell-off. So bad so that something like Safaricom, which was a favorite for foreign traders, for foreign investors, has dropped from a high of probably 40 to, from an all-time high of about 40 to about 15 where it is now. And the company's performance is the same, if not improving. So that should give you an indication of how the market has been as a microcosm, so to speak.
And indeed, we have also seen a lot of, as you have said, foreign investors fleeing the NSE. What other factors are leading to this?
So there's that, but also there's the issue of rising interest rates. So when interest rates rise, as you might, as you will appreciate, valuations generally fall because, and these are two reasons. Number one, the discount rate you're using to value has dropped, and number two, because of lower demand as a result of higher rates make financing more expensive. So all the levered investors will stop trading and reverse their positions. So yeah, you've got those two factors, lower valuations and lower demand, both of which will lead to lower prices.
And as you've mentioned, interest rates there, Nderi, looking at the trends, central banks around the globe, really, they will probably continue raising their monetary policy rates, in a bid to tame inflation. So what will this mean for the bourse going forward?
I honestly think we're close to rock bottom, and here we are looking to see if there's going to be some rotation away from bonds to equities, because higher interest rates, the bonds, when you've got prospects of rising interest rates, that could mean capital losses, and maybe some people are beginning to think of other avenues to invest because the underlying assets either are very, very undervalued, or the prospects of growth are quite strong, especially for companies that are exporting, so for example tea and the like, so which we are paying very close attention to. So those are the kind of dynamics we are looking out for.
So are we also seeing institutional investors shifting, to the treasury bonds as they are deemed to be safer?
Not in our markets. In fact, for us, the shift has been more short-term, A, for protection of capital, and B, because there's some murmurs of the fiscal position doesn't seem very healthy, and indeed the government has come out and said that as much. So people are looking at different alternatives. So for now, in fact, what is happening is most people are going to the very short end, and that's the 91 day. There's a 3-year bond out in the market right now, in the primary market, and we are waiting to see how that performs, to see whether I think the results should be out tomorrow or the day after. No, tomorrow is the auction, so the day after. So we're keenly waiting for those results, because that'll be a very interesting indicator of how the market sees the government as a borrower. So we're looking at also alternatives for investors who believe who want to hold different positions.
So with this foreign investor flight, and there we are seemingly seeing that the market is being kept afloat by local investors. Is this necessarily such a bad thing?
Yes, because there's been quite a bit of erosion of capital, so to speak. Of course, everybody would have preferred that the pricing doesn't have to come down. It would have been nice if the pricing didn't come down and valuations, valuations remain the same, and locals participated more, because that would have been a function of higher savings rates. But this is we are being abandoned in the party, and it's not a very good feeling, especially when the abandonment is manifesting itself also in the prices.
Yeah, I actually asked that because there has been this push to have more local investors, and having the bulls being carried by, local investors. But as you're saying, it's a dicey situation there. But we have seen a plunge in shares, share prices in some of the NSE listed firms. And I want you to talk to me about, you had alluded earlier to Safaricom. I also want to look at some of the top performers like KCB, Equity. What are we seeing in some of these counters?
So Safaricom, I think, is interesting because of its adventures in Ethiopia. Ethiopia is a very interesting country. Over 100 million people in population. I think Safaricom could be probably one of few other quality alternatives. But also Ethiopia is liberalizing, and we hope to see an open capital market. That would be very interesting for Safaricom as well, because we're talking about repatriation of profits, and that's one of the key concerns of investors of Safaricom. The other interesting thing is the M-Pesa. I think there's a regional drive for the product itself. The hope being that they can replicate the success M-Pesa has had Africa-wide, sort of like what Flutterwave and Cheaper Cash are trying to do. And then the banks, especially KCB and Equity, I think the story there is the growth in DRC, very interesting as well. Huge markets there, and as stability is established in that economy, huge economy in terms of resources, and a huge potential in just other areas of economic growth. So all that is very interesting for us.